Regardless of whether or not any of us like gold as an investment vehicle, it is investors with real money and clout that create trends, whether the fundamentals are crystal clear or not. This is what makes gold a fascinating story and why, during the financial crisis, its price was catapulted by buyers of the largest gold-backed ETF, the Spider Gold Trust, ticker GLD. By parking a chunk of capital in such gold-related funds, a protracted bull market was born that vaulted the value of the precious metal to $1,920 per ounce back in 2011. A recovery in the value of the dollar on the heels of remedial policy response by the Federal Reserve caused that bubble to burst, forcing liquidation of gold holdings as investors swam to the safety of the nearest equity market rather than clutching onto a losing end-of-the-world view on gold. Through 2015, gold lost 45% of its peak value, falling to as low as $10.46 per ounce. However, the return of geopolitical chills, driven by fears of a collapse in the Chinese economy, has seen the spotlight fall back onto gold, which recently surged to $1,306 per ounce. According to a recent SEC filing by BlackRock, the behemoth investment manager spent the first 2 months of the year buying around 30 million shares in the gold spider. Its end 2015 position of 3.4 million shares compares to a prior peak holding at the end of 2010 of around 10 million shares. According to Bloomberg data, BlackRock's average entry price is $114.79 compared to its early May peak above $124 per share and a current price of $116.95. The value of its positions, likely spread across multiple funds, is $4.17 billion according to Bloomberg. Demand for its shares caused the ETF to create 45 million more shares to meet demand through the end of February. So BlackRock now owns 12.3% of all outstanding shares in GLD. To put that in perspective, you'd have to add together the combined holdings of Paulson & Co., First Eagle, Capricorn, Morgan Stanley and Fidelity to come close to matching BlackRock's position in the fund. In fact, its position is the same as the next 12 largest fund holdings. The question is exactly what portfolio managers at BlackRock are afraid of. Despite its intervention in the gold market, to their credit, they've called a lot right this year, at least in terms of framing a bull market for gold. Gold simply loves a bear market for the dollar, and in combination with a stalled attempt to normalize short-term interest rates, the environment has been favorable to gold prices. Investors have abandoned the view that the dollar will have a significant yield margin over other currencies, especially if the central bank looks outside of its shores to gauge the outlook for growth. Fear of negative interest rates have bothered rather than bolstered the value of the dollar. And the worry that central bankers are losing the plot has unnerved Japanese investors into favoring the yen over the dollar, causing further angst over broader risk appetite. Indeed, dollar positioning in the futures market recently drove the net speculative position to a bet against the dollar for the first time in several years. After a shoddy start to the year, China remains a wild card, although the worst of the negativity surrounding a hard landing appears to have dissipated. However, US stocks seem more concerned over the outlook for earnings and from creeping fears that overall economic growth is likely to remain tepid despite the Fed's successful attempts to rejuvenate the economy through unconventional means. Looking at BlackRock's investment expressed in gold, the position appears to be an admission of concerns about the investment outlook. First, stock markets restrained by earnings are struggling to build on year-to-date highs set in April. Second, the investment manager is a true heavyweight in the business and, to its credit, employs some of the smartest minds in the world. If they are worried about more than just the end of a dollar bull market, it is a voice worth listening to. Third, its sheer stake in the gold market is worrisome. As the largest holder in not only the GLD, but also in the IAU, its very stance has the capability of unnerving other investors. BlackRock is not the only investment firm hoarding gold. Recently, legendary investor Stanley Druckenmiller expressed its view that investors should quit stocks and buy gold. And Bill Gross at Janus wrote an excellent thesis on how the Fed's unconventional policy may become mainstream in the years ahead in response to technological change, permanently displacing labor. If the economy fails to spawn inflation or wage growth to the extent that the Fed feels the need to continue raising interest rates, BlackRock may just be hugely right.